Hello again and welcome to this presentation on risk. In this presentation we will cover risk tolerance and what that means. What are some general characteristics that tends to associate with certain risk level? How risk tolerance influence investment? And what are some risks associated with investments? At the end of the presentation you will have the opportunity to take a risk assessment. This assessment will give you an idea of where you fall in the risk tolerance spectrum. So let's get started, shall we? In the consideration before investing presentation, we've touched a little bit on risk tolerance. To review, in terms of investment, risk tolerance could be viewed as the extent in which an individual is willing to take on more risk in exchange for the possibility of getting greater returns from an investment. So if you have a high level of risk tolerance, you might be willing to invest in a more risky investment product for a possibility of higher return. If you're on the other end of the spectrum, that is, your level of risk tolerance is fairly low, you might be more comfortable investing in the product that is less risky. Not everybody has the same level of risk tolerance, and an individual's level of risk tolerance depends on several factors. These factors include personality, personal experiences, current financial circumstances, and time. For instance, if you are young, have some experience investing, and enough money, you might be open to take more risk when it comes to investing. In the next slide, I will go over some of the characteristics that tend to be associated with certain risk levels. So in the last slide, I mentioned that personality, personal experiences, current financial circumstances, for example, wealth, employment, and income, and time are some of the factors that influence risk level. Other characteristics that influence risk level are gender, marital status, age, family type, and education. This table lists the characteristics and the risk level that tend to be associated with these characteristics. Using the table, we see that if an individual is male, single, young, has no kids, and is wealthy, has a white-collar job, earn a high income, and is college educated, then he might tend to take more risk. On the other hand, if the individual is female, married, older, has kids or children, and is poor, has a blue-collar job, earns a low income, and does not have an education beyond high school, then she might be less likely to take risk. As mentioned before, your risk tolerance will influence your comfort level with investing in a variety of products. The investment pyramid on this slide shows some investment products and the risk level that are generally associated with that investment product. As you can see, cash, CDs, and money market funds are some products that tend to have lower risk. These investment products are sometimes classified as financial security products. The investment products that are often associated with higher risk are those in the speculation category. These products include speculative stocks, options, and commodities. Precious metals such as gold, gemstones, and collectibles like baseball cards can also fall in this category. Investment products are not the only risk associated with investment. Some of the other risks that are associated with investment include taxes, inflation, interest rate, business failure, market, and global investment. With taxes, if your investment is not protected within a tax shelter account, then you would have to pay money on the earnings from your investment. When you pay taxes on your earning, you will have less money to reinvest and thus get less interest from your investment overall. Inflation deals with buying power. If your investment return does not keep up with inflation, you will have less buying power with your money. Interest rate has more impact on bonds than in stocks. This is because when interest rate increase, the bond value decrease. Interest rate impacts bond investor in terms of opportunity cost. When an issuer issues a bond, the interest rate for that bond is generally at or close to the market interest rate at that time. If the interest rate increased after the bond was issued and bought, the interest rate of that bond does not increase in response to the increased interest rate. So you would lose out on any gain. Let's take an example. Let's say that in 1 year you invested in some bonds and the current market interest rate at that time was 7%. When you buy that bond, you are committing your money to that investment product for a certain amount of time at a fixed interest rate of 7%. The next year, the interest rate increased to 8%, and the bond issued that year yields 8% in earnings. But the initial bond you purchased the year before continues to return 7% to you. Unless you have more money to buy the 8% interest bond, you will miss out on the increased interest rate. So this is an opportunity cost example. Because you already invested your money in the 7% interest rate, you won't have enough money to buy the 8%. Business failure impacts investment because when business fail, say the business file for bankruptcy, you as an investor will likely lose all the money you invested in that company. When a business files for bankruptcy, the assets of that business are sold to repay creditors. It is not often that there will be money left over after the creditors are paid off to compensate investors. Market and global risk has to do with the ups and downs of global market. Generally, when market fare well, investors get more from their investment. When market does not do well, investors get less from their investment. Thank you for listening to this presentation on risk. Please take a moment to complete the risk tolerance assessment and the investment pyramid activity. You can find a link to this activity on the main Moodle page.